Hi guys, welcome to another episode of Global Macro Flow. So today we're going to be asking this question: buying stuff in financial markets just because they are cheap? Uh, it's a very interesting question. Let's look at it from the ordinary market perspective. Anytime you want to buy like TV, shoes, or clothes, imagine let's say the price was a month or 3 months ago, the price was like for that shoe or for that TV or for a set of clothes, £5,000 or $5,000 or 5,000 naira, depending on the country where you're in. And maybe a month later or 3 months later, you see that same TV or that same commodity you want to buy, shoes or clothes, instead of being £5,000, it's now £2,000 or $2,000. Maybe due to sales that is going on in the store or any other price drop reason. What do we tend to do naturally? We jump. We're like, hooray! This stuff that was like £5,000 before or 5,000 naira is now just 2,000 naira. That's great. That's amazing. That's great, and we jump in and we buy it, or we even hope and wait and say, you know what, it's 2,000. It might even drop even further, so I'll wait. As it goes lower, I'm going to buy more. However, in financial markets, can we apply the same logic to that? I know most people do that, but is it really advisable to apply that same logic? I'll just show you a chart of the S&P index. The S&P index is basically a stock market index, so it gives you a value of, it's like all the stocks or a representative basket of all the stocks in the US stock market. So if you see the S&P index rising, it means stocks are generally rising. If you see the S&P index falling, it means stocks in the US are generally falling. So there's a simple chart of the S&P index here. It's a weekly chart, so it generally shows you how the week in the stock market index for US stocks advances. So you see here, from about 2003 2007, that's about 4 years of consistently rising. The stock market is consistently rising. That looks good, yay! But then but most time be like, oh, this thing is too high. It's gone to about 1,500, and then all of a sudden it begins to drop. It drops to about 1,380. Then someone might say, oh, that's a good idea. Now it's cheaper than what it was. That's about 200 points off or 100 points off. I could buy more. But then all of a sudden it falls again to about 1,270 area. And then people are like, wow, I could even buy more. That's cheaper. That's a bargain. And then what happens next? Voila, a massive drop. It drops all the way to about 910. And then all of a sudden it stabilizes a little bit. It's cheaper. And then what happens again? It still drops again until it got to a low of about 640. And this went on for about a year before it then began to stabilize and the markets got restored back and moved to all-time highs. But think about that. Anyone who thought, oh, it was cheaper at a point in time when it was 1,400 and bought a lot will have had to wait for about a year or even 2 years or even 3 years. It depends on where you bought, to have gotten back to break even. So break even is like, let's say you bought at 1,400. The break even is when the price will get back to 1,400. So it took a year or 2 years or 3 years, depending on where it was bought, to go back to break even. So if you kept doing that, for example, oh, this is cheap at the point just at the middle of 2007, you will have either lost a lot of money or taken a lot of time to get back to break even. And we don't even talk about inflation and the opportunity cost of that money. So I think we need to think about it. The mentality of, oh, we get something when it's cheaper, it's not really advisable. So I want us to look at it. What do we do then? What do we do? I think we should start to see investments in stocks and financial instruments as buying a luxury good or perishable goods like milk or things that easily expire, or as a luxury good. So for example, if you're buying like the latest Louis Vuitton bag, you're buying it because it's expensive, because I mean you want to show class. So if the price keeps dropping like a rock over a large time frame, say 1 month, 3 months or above, it's likely that stuff is not more quality anymore. It's losing value, so you won't want to buy it. It's almost like having milk. You're buying milk, and the milk costs a particular amount, and all of a sudden the price drops massively. Yeah, milk is very, very. It's a component that, I mean, if you buy something that is bad, it can be dangerous to your health. So think about like investing in stocks and financial instruments as buying a luxury good or perishable good. The best time to actually buy is when after maybe a downturn in price or consolidation in price. Consolidation basically means like price is ranging and then price is beginning to turn back up. So that's the best time to buy. So on the SPX chart, you see that around 2009, when the price began to stabilize and then began to turn back up, that was the best time to actually buy. Not when it looked like as if it was cheap. When it was actually beginning to rise back up, it's actually the best time to buy. Why is that so? It means that people are beginning to value that financial asset or instrument again. So it's contrary to what you like to think normally, but it means that people are beginning to value that instrument again, not the opposite way, of thinking. So you could see we require a little adjustment to our mindset when buying financial assets or stocks or any other financial instrument in the financial market. It's a very, very important adjustment to your mindset and save you a lot of money in your wealth building journey. So our call to action today is simple. Have you or someone you know tried to buy financial assets in the past? Did you observe this mindset of, oh, it's cheap, I'll keep buying more as it keeps falling? Did you observe that? So what do you plan to do to adjust that mindset in your life? Let me know what you think. Tweet me at Donvuz, at DONVUZ. Look forward to hearing from you. Bye.